Sunday, January 19th, 2020, Maneco 64, home of alternative economics and contrarian views. Today I want to talk about how gold fares in a deflationary environment, in an environment much like Japan in the last 3 decades. I mean, the definition of deflation that we get from the mainstream economists, from the Keynesians, because if you look at Japan, under the current fiat currency system, debt, of course, is money, and we've had Japanese government debt balloon to over 200% of GDP. So that basically is inflation. So it's a bit confusing. By deflation, I mean then a moribund economy, the cost of living rising and rising for the general public, no economic pickup, and always near recession, the economy. And that's what Japan has had. They call it the lost 3 decades. Before I look at some JGB EO charts, the price of gold in Japanese yen, also the 10-year yield in the US, to see if we're going to get the same kind of thing in the US as Japan. Just want to talk a little bit about Japan, what happened in the 80s, late 80s, and after the Nikkei topped on December 29th, 1989, just below 39,000. What happened in Japan is that there was a massive bubble from the mid 80s until the late 80s. Why was that bubble? In my opinion, is because of the Plaza Accord in New York in the mid 80s, where the major G4 or G5 at the time, don't remember exactly, but basically the US, Japan, France, Italy, and Germany decided to allow the dollar to drop. Dollar was very strong back in the early to mid 80s. So the consequence of that Plaza Accord, I think it was 85 years, was that the dollar dropped massively against the yen. You can see here it was trading around 260, and by 1988 it had dropped down to 120, the dollar. So that means the yen strengthened, the Japanese yen strengthened. And you might have thought, Japan being an exporting country, that would have hurt Japan, but it didn't. It actually encouraged a lot of foreign investment. A lot of money flowed into Japan, into the stock market, into the property market, and there was a huge stock market bubble, property market bubble, real estate. There's a little statistic or information that was out there that the land of the Imperial Palace in Tokyo at the time was worth more than the whole state of California, something crazy. So as you can see here, I think that's what pushed the bubble in Japan. The fact that their currency actually appreciated a lot. There's a lot of foreign investment. The Japanese companies are doing really well. I remember well at the time that people were trying to emulate the Japanese companies, their efficiency. So it was all about Japan. They bought Pebble Beach golf course. They're buying everything. I think they bought the Rockefeller Center in New York. So that was the background for the bubble in Japan. And it was a massive bubble. People were doing well. Their property prices are going up. Their stock portfolio was going up. So let's look at the Nikkei, what happened to the Nikkei as well. So you can see here from this Asian review, asia.nikkei.com, Asian review, the little chart here, see what happened from 1985 with that Plaza Accord, with the yen soaring. We saw the Nikkei go from around 10,000 to almost 40,000. So, and it topped right on December 29th, 1989 at just below 39,000. And then everything imploded. The Nikkei collapsed. What triggered it? Sometimes things just turn. That's what happened. And the consequence of that was much like the '08 crisis in the West. in the United States and Western Europe. The major Japanese banks were all in trouble. The Japanese government intervened to save the banks. I remember very well in the mid-90s, early 90s, working in the city. A lot of the talk was that Japan was doing the wrong thing. They were intervening instead of letting the banks collapse. The first zombie banks were these Japanese banks. So that's what happened. Yeah, the Japanese government just kept saving the banks, keeping the banks alive instead of flushing out all the malinvestments. And that's the other reason why, in my opinion, they've had 3 lost decades, because they've kept these banks going, these zombie banks. What has been the drawback? What's the consequence of it? My opinion, it's all the debt that the Japanese public has had to incur, the national debt of Japan, to over 200% of GDP. That's to save the banks. And at the time as well, there was some criticism that Japan wasn't doing enough QE, and maybe they didn't. I don't think it would have helped. But later on, they really got involved in QE, and they've been doing QE ever since. I'm not sure exactly when they started doing it, but we know now that the Japanese central bank, the BOJ, they're even buying ETFs in the stock market. So it's been a lost decade, 3 decades. Japan has never, the Japanese economy has never regained the strength it had in the 80s. Granted, that was a bubble, and the consequence of a bubble, bubbles are always really, how can I say, damaging afterwards. And look at this one, especially when governmental and central banking authorities try to intervene instead of letting the market and bad companies, bad banks go the way of the dodo bird, go extinct. They haven't. These Japanese zombie banks still exist. So we've had 3 decades of what they call deflation. The Japanese economy has never picked up again that strongly, and they've been stuck at 0 rates, negative rates. And that's what a lot of people in the financial markets, in the US, in the City of London, in the West, that's what they're hoping for, that the US, Western Europe can muddle through like Japan. And why would they want that? Well, because it's okay for the financial assets. I know the JGB hasn't picked up. I mean, it's still, let's see where the JGB is. It's still at 24,000, so way below that high of almost 39,000. But it's kept bond prices high, it's kept the banks solvent, and I think that's why the economists at the banks, hedge funds, investors, that's why they hope that the West can keep muddling through. But I can tell you it's going to be really bad if it keeps going like this for the general public. The average Japanese hasn't really benefited at all in the last 3 decades. And I'll show you as well that their cost of living has risen. I've heard as well that they've got a lot of, how can I say, infrastructure spending from the government. Yes, that helps the numbers, economic numbers, but it's not really, how many bridges and new roads do you need in Japan, right? I'm gonna show you now, first the JGB yields, the 10-year yield, bond yield, what it has done, and then I'm gonna look at the price of gold in Japanese yen to show you that probably the best assets to have in a situation like Japan is government bonds, because they're going to keep intervening, printing money to keep buying these bonds, to keep the system going. But there's no way around the fact that the currency actually depreciates versus real money or gold. And the same thing will happen and has been happening, in my opinion, for the US, for Western Europe. And even if the central banks and governments don't succeed in keeping this bubble going, in keeping yields low, this zero-bound economy, lost decade like Japan, if they don't succeed, I think gold will do well as well. Government bonds, not too sure. And I also wanted to let you know about a little video I remember well from CNBC in 2009. I'll put a link to it below in the description of the article that has a video of Evelyn de Rothschild talking to Maria Bartiromo, just like after the '08 crisis back in 2009. And if you listen through the whole video, he says that he's holding on to government bonds and gold bars. So there you go. So let's have a look at the JGB yields. And we've got the JGB yields here, the 10-year yield since, late 80s. And you can see that it was between 5 and 8% in the late 1989, 1990. This is from the Federal Reserve Bank of St. Louis, actually. And you can see that it's been dropping ever since from 8%. And it's been like near zero. It's negative right now. It got negative the first time in 2016. So a lot of people think the same thing's going to happen. Well, it's already happened in Europe. They expect it to happen in the US as well. Now let's have a look and see how gold has done in terms of Japanese yen. Because as you saw earlier, the Japanese yen has risen, of course, against the dollar. It did very well. The Japanese yen has done well since the top in 1989 of the stock market and the bubble. This chart here is downward. The trend is downward, but that means that the dollar has gone down. So if anything, the Japanese yen is quite strong. It stayed between 80 and 120. So the Japanese yen stayed quite strong. But look at the gold price in Japanese yen. It was at 60,000 at the top of the stock market there, just in the beginning of 1990. And now we're at 171,000, almost 172,000. So I did a calculation here. So in spite of the fact that Japanese investors who swapped out of dollars 30 years ago are doing fairly well, they would have done even better if they swapped into gold. Back in 1989, I calculated the gold to Nikkei ratio instead of the Nikkei to gold ratio. And back then, with 1 ounce of gold, you could buy 1.54 Nikkei 225. That was right at the top, December 29th, 1989. Now, as of Friday, with the Nikkei at 24,000 and the gold price at almost 172,000, you can buy 7.15 Nikkeis with gold. So gold does well in a deflationary environment as well, especially in an environment where there's a lot of liquidation. Even though they've kind of kept the banks going, there's a lot of other companies that go under. Gold is a good place to be. So let's have a look now at the U.S. Treasury 10-year yield. As you can see here, the bull market, it's a bull market in the price of treasuries. It's a bear market in the yields. Some of you know, of course, that when bond yields go down, it means that people are buying the bonds, the prices are going up. They're inversely related. So we've had a bull market in treasuries since the early 80s. And right now, we're just around 2%, just below 2%. We've been below 2%. I'll show you a shorter term chart here. You can see that Back in 2012, we almost got down to 1.4%. In the summer of 2016, we got down to around 1.32. And then last year as well, we almost got back to 140 there. So right now, it looks like that 140 level is very important. We did go back up in the yields, almost back up to 2%. Right now, we're around 180. So to me, it looks like these yields could drop again. And if we break through 1.4, some people that I've spoken to who follow the bond markets, who work in the bond markets, they see yields accelerating lower if we drop through this 1.4%. So maybe we are going to see this Japanification of the US bond markets. Maybe we're going to see the economy muddle through. Yes, the US economy has done a little better. There's a lot of cheerleading, of course. The US has done a lot of deficit spending. The last couple of years, 5% of GDP. They're going to, Larry Kudlow just said the other day, they're going to come up with another tax cut that should be higher deficits. And don't forget, the United States, unlike Japan, is the policeman of the world. So military spending and war spending helps the American economy a lot. I think if the US wasn't spending as much in the military or intervening almost everywhere around the world, the US economy would be much more like the Japanese economy. And I'm not saying the US economy is doing great, because I think it's more the top people that are benefiting from this continued inflation of the system. And by inflation, I mean the pumping of more and more debt to keep the system and the banks going. So there you have it. Whatever happens, in my opinion, I think precious metals will be a good place to be. You can see how it has done well, a lot with the Japanese yen. A lot of people say, oh, gold's no good. Look at Japan, they've been in deflation for 3 decades. But they forget to look at the how well gold has done in Japanese yen, even though the yen has actually strengthened against the dollar. So what's the spanner in the works for this muddle through scenario that a lot of people out there think is going to happen to the US and Western Europe? Well, the spanner in the works is that we get a collapse of the system, that they can't keep the government bond bull market going anymore, and you get a inflationary scenario, and gold will do well then too. I think the time when gold doesn't do well, when there's not much debt, when the economy is growing well, and the markets are healthy. And we don't have that now. I think it's a good place to look at Japan, but it doesn't necessarily mean that what happened in Japan in the last 3 decades is going to happen in Europe and in the US. I mean, you could argue the last decade has been a wasted decade for Europe and the UK. We saw the other day UK retail sales numbers were really weak. GDP is anemic. Earlier today, I played golf this morning. It was very cold, but it was a nice day. And after the game, a friend of mine who I played with said, where's the best place to invest? And I said, before you invest, you need to look at the currency of your country, of where you live. That's the most important thing. And then you look at investments. Because I told him in 2007, if you had taken £100,000 and put it into dollars, that would have given you $210,000. And now, if you took those dollars and switched them over to pounds, you'd have 160,000 pounds. Just a currency transaction, no tax, because it's money. There's no tax on foreign exchange in the UK. So think about the currency first. Don't forget gold. That's a currency as well. If you enjoyed this video, please hit the like button. Please share it far and wide. Subscribe to the channel if you haven't yet. And you can also follow me on Twitter, BitChute, Steemit, and DTube. Billy and I wish you a great rest of the weekend. Take care. Bye.